In this course, we're going to get into stock investing strategies, and we're going to start with covered calls. So what do you need to know in order to really fully grasp this course? Well, obviously you would like to know how to buy stock. You would like to know how to buy and sell calls, and what calls are as far as like what bid-ask spread means, strike prices are, what debit and credit means, expiration, etc. If you don't know any of this stuff, I highly recommend you take my Option Trading for Rookies Understand Options Completely course, where all this is done in depth. Now we are going to go over this again in this course, but only quickly and concisely. If you don't understand what we're talking about, then once again I highly suggest you go back and take my course here. It will explain everything you need to know about options. So what are we going to learn in this course? Well, we're going to obviously start off with covered calls and defining them, why you need to manage your own money at all, what cost basis is, choosing what call to sell. We're going to look at cost basis versus POP versus ROR. Probably doesn't make any sense to you at all right now, but don't worry, we're going to explain it all. And we're going to end off with live trading examples. So let's start off with what is a covered call. And as I always like to do with my courses, I use the driving the car analogy. So for those of you that aren't aware of what that means, let me show you. When I say driving the car, what I mean is this is a car, and these are all the pieces that go into a car. Now I've spent the last multiple years learning all these pieces, so I know how to build the car. But you don't need to know how to do this. All you need to know with the car is how to drive it. And that's what I'm going to teach you. I learned all this stuff, and I've created this course in this format. Just take what I know and learn to drive the car. It's that simple. So let's start off with what is a covered call. Let's define it. A covered call, as you see here, is an option strategy whereby an investor holds a long position in an asset and writes sells call options on that same asset in an attempt to generate increased income from that asset, also known as a buy right. Blah, blah, blah. You know, what does that mean? Well, real simple. English translation, all it means is we buy stock and we sell calls against it. But why even bother? Why do we want to take the time to learn how to do this? Well, as you can see here, this is the mutual fund manager chart, and what we're doing is we're comparing it to the S&P 500 returns, which is just the benchmark that most funds use to compare themselves against. And if you look here, you see, which is scary, 76% of mutual fund managers have underperformed that benchmark over the last 10 years. Wow, these are the supposed professionals, and if you had just bought the S&P 500 by itself and done absolutely nothing but hold it, you would have outperformed 76% of these supposed professional mutual fund managers. Okay, that's pretty scary, right? If I just bought it and done nothing, I'd beat 76% of these so-called professionals. But here's the other scary part. Even here where it says 24% of these mutual fund managers beat the S&P 500. So you probably think, well, great, hopefully I'm one of those guys that gets lucky and gets in that 24%. Well, the majority of these people do not include fees when they talk about their returns, which means if the S&P 500 got a 10% return and your mutual fund manager got an 11% return, but they charged you 2% worth of fees, so in reality, that 11% minus the 2% they charged means you only actually got a 9% return. Okay, are you following me? But there's a 10% return if you do nothing. The majority of those people don't include fees, which means the majority of mutual fund managers actually underperform the S&P 500. In fact, the real number is 95% of mutual fund managers, when you take fees into account, underperform the S&P 500. Holy smokes. So that means these supposed professionals are paying lots of money. If you had just bought the S&P 500 by yourself and left it alone and done nothing to it, you would have outperformed 95% of these professionals over the last 10 years. That is scary, and that is why we are taking the time to learn how to manage your own money. So what is our goal with this course? First and foremost, it's obviously to teach you to manage some of your own money so you can save on those mutual fund fees. And how do we do that? Well, we do that by learning to teach you to lower your cost basis every time you buy stock, which will increase your chance of making money, which you will learn coming up. How do we do that? We do that with something called a covered call, which is a stock option strategy. So let's move forward.